Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Looking at Realty Income Corp again. They just had their Q3 earnings call. This is a stock everybody loved in the 70s, kind of hates in the 50s. Such is the norm when stocks go down. They just announced an acquisition of Spirit Realty. Their stock dipped into the mid 40s at that point. I did buy some more shares then. I do own this stock, so FYI on that. I did do a video on the acquisition just a week ago. I will link it down below. Check it out. The stock is back up into the 50s after the earnings, after the market digested the acquisition, which wasn't that bad. So let's look at the earnings. A couple of things that I liked about the earnings were recapture rates of 106.9%, really solid, a lot more than I expect for a retail REIT. I generally expect 2 to 3% increases on recaptures. You're talking about 6.9% for the quarter. Now, a lot of that because there was a big industrial client in there, and those generally have larger recapture rates. But even for the year, they're still at 104.3%, which means that anytime a lease expires, they're renewing it or releasing it to a new client at a rate that's 4.3% higher than what it was before expiration. So that's pretty good. Going to have some natural growth from getting higher rents for releasing lease expirations. And you want to see that above 100%. Obviously, it doesn't happen all the time, but it should happen in a healthy REIT, and that's certainly continuing to happen here. They are continuing to make acquisitions, mostly in Europe for the quarter, which is interesting. Generally, their acquisitions are kind of 60 to 70% US, 30 to 40% in international markets. This time it's like 80% in Europe actually, and that's mainly because of two large sale leasebacks, the ASDA and Morrison's, two grocery store chains, and now grocery stores make up about 50% of their international portfolio, which I kind of like. When you talk about the cap rates, not too amazing, 6.9%. They kind of talked about that in a defensive manner on the call. Again, weighted cost of capital has gone up, probably closer to 6.9% actually on a current basis, but when they were making these deals, that was 6 to 12 months ago when they were funding these deals, that was issuing shares 6 to 12 months ago, maybe closer to now, but their cost of capital for these deals were closer to 5.8%. So still a spread in relation to the cost of capital versus what they're actually getting. And one of the things they mentioned is that when they do deals in Europe, the rent escalators are pretty good. A lot of them are uncapped CPI, which is what they need more of, right? A lot of their current leases are kind of fixed or capped in some way. They don't have CPI escalators, and that leads to lower same-store sales growth when it comes to rent increases, rent escalators. So you can kind of see that's improving as well. 9 months, they're at 1.6%. In the last 3-month period, it's 2.2%. More Europe exposure, more international exposure, more uncapped CPI exposure. As they renegotiate some of these deals, they're probably putting in CPI escalators, which is a good thing. And again, more exposure to industrial, which has better escalators than retail, because retail escalators are generally going to be in that 1 to 2% range, which is not amazing, but it's still something. And the guidance for 2023 was actually pretty decent. You're talking about a raise on the bottom end of the AFFO per share guidance. It's still probably going to be in that 1.5 to 2.2% increase over 2022 range, which isn't amazing. And a lot of that is, again, cost of capital is going up. They have to refinance at higher rates. They're not growing as fast. And part of it, too, is that their same store rent growth, I think I said sales growth, same store sales, it's kind of in my mind, is only 1.5%, but that's better than the prior guidance of 1.25%. Sorry about that. And some of that is better recapture rates, better same store rental revenue for this quarter. And I think that's going to potentially be what's going to drive better than expected results in the future as some of these leases go up for renegotiations. They're going to put in better CPI escalators in there. Potentially having some uncapped CPI escalators in Europe is certainly going to help. And that is a good thing for the REIT on a go-forward basis. They're still acquiring a lot, $9 billion in 2023. But one thing they mentioned is as they look at the private markets, they're not moving as quickly to reflect the new normal when it comes to cost of capital. By that, I mean that if their cost of capital is 6.9% today, the cap rates could potentially still be 6.9% today. And that's not what you want as a REIT. You cannot acquire things for the same valuation as your cost of capital because you're making no money on that deal and you're taking on additional risk. in terms of occupancy, etc. Occupancy still here is pretty good, but what they need to see is they need to see those cap rates go up to 7.9, 8.5%. So those spreads exist again. They're just not happening as quickly as they'd like. And that's one of the reasons they probably acquired Spirit Realty, because the public markets reflect that new reality really quickly. I made a video about that a couple of weeks ago. I'll link it down below as well, just why REITs are down in general. So when they made that acquisition, yes, they're issuing shares at a lower valuation. They're issuing shares of O at a lower valuation than historically they've issued shares at, meaning that the multiple they're getting now is maybe 12.2x versus a historical mean of that 15 to 16x range or something of that nature. But they're acquiring Spirit Realty at an even lower multiple, which is why it's accretive to their 2024 AFFO. And that's a good thing. That's, again, I won't talk much about that, but keep that in mind as we go into the 2024 guidance, because it's accretive to 2024. And when they talked about their 2024 guidance on the call, they actually said, we expect to grow in the 4 to 5% range. And I think the market was more expecting 1 to 2% again, kind of what you're seeing in 2023. And 4 to 5% AFFO growth for 2024 is really solid, considering some of the challenges they're facing. And one of the challenges they're facing, again, cost of capital is going up, and their long-term WACC right now is like in that 7.5% range. This is a sheet they include in their earnings presentations, and this is always updated. You can kind of see cost of capital on the equity side has gone up quite a bit because their stock is valued at a 12x multiple now, right? They could issue shares at a 15x multiple before, now it's a 12x multiple. The cost of equity has gone up, and the cost of capital on the debt side has gone up as well. So the long-term weighted average cost of capital was maybe 7.5%, maybe a bit lower. Nominal for first-year weighted average cost of capital is that 6.8% range because they can fund some of the acquisitions with free cash flow. They need cap rates to be better than 6.9%, right? That's why that acquisition this year is not as amazing as it's going to be next year. Probably cap rates are going to be in that 8% plus rate once the private markets actually reflect the new normal of weighted average cost of capital. Again, we're going to talk about the other concern as you move into 2024 and why I was surprised by their 4 to 5% guidance. They're going to have to start refinancing their debt, and their debt is kind of well laddered, but it's going to become a problem starting in 2026. And let me kind of talk about why this is a problem. So think about the company, once combined with Spirit, is going to have about $4.5 billion in annualized rent. Now, they have escalators in that. Let's say those escalators are about 1.5%. Let's be conservative there. That means that every year the rent is going to go up by about $70 million. That's a good thing. Their costs do go up, but maybe not by that much. So that flows down to the bottom line in a way and improves the AFFO if that $70 million is more than the increase in costs. So that's additional operating cash flow that they have to spend on deals, to pay down debt, etc. Now, the problem is that their debt is currently in that 3.8% range. If they refinance it, they're probably going to have to refinance it right now, at least closer to 6.8%, just to be simple, to raise it by 300 basis points. Now, you're talking about almost $2 billion in debt in 2024. If you're refinancing that at a rate that's 300 basis points higher, that's an additional $60 million in interest expense that is going to kind of flow down to the bottom line as well as an expense, which makes it harder to grow AFFO. So if they're expecting to grow AFFO 4 to 5% despite this headwind, that is a really good thing, because you're going to see the same thing in 2025. Again, your rents are going to go up by, let's say, 72 million at that point because your rent base is a bit higher and you have that same 1.5% escalator. But your interest expense is also going up by almost 60 million because you're refinancing another almost $2 billion in debt. Now, 2026 is a bigger problem. You're going to have a rent escalator that yields about $75 million in rent, additional rent. And again, this is assuming no growth, it's just to simplify it. But your interest expense, if interest rates are as high as they are today, is going to be $120 million more. That's the problem that REITs are facing, that their interest expenses are going to go up quite a bit and are going to put pressure on the bottom line if interest rates stay elevated. Now, obviously, interest rates could come down. They could refinance at lower rates, which would make it as much of a problem. Obviously, on the reverse, interest rates could go up. But that's kind of why REITs are in a pickle right now, because they're going to have to do something with this debt. And that means that's going to impact their bottom line. And it's less impactful to a company like Realty Income, which has a decent amount of leeway when it comes to their operating cash flow in excess of their dividend. But it could be a problem for other dividends that don't have that. And that's why you've seen some dividend cuts, because they see the specter of this refinance. That means really high interest expenses on a go-forward basis. So for me, seeing that they're going to grow their AFFO in 2024 at a 4 to 5% clip, assuming no new equity is issued. So I think they're planning to fund some acquisitions with debt if they do any, but I think a lot of their acquisitions for that year are kind of done with the Spirit acquisition. And that also, that 4 to 5% growth assumes that the deal closes in January or February. So kind of baked into there. So seeing 4 to 5%, despite the headwind of an additional $60 million in interest expense for 24, makes me kind of feel okay about potentially 4 to 5% growth in 2025 as well, because you have the similar headwind. Maybe lower growth in 26, 27, and 28 if interest rates are still elevated, because that headwind is going to be larger. So I could potentially see that drop to, no growth in 26 because that interest expense is so high, and maybe slightly muted growth in that 1 to 2% range in 27 and 28 if they're still refinancing at 300 basis points higher than their current yield in those years. So that's something to keep in mind. So as I look at this stock, do I like it still? Yes, because I think if you look at Realty Income, they have probably with Spirit close to $3 billion in operating cash flow, which is really solid. Yes, they're going to pay out $2.1 billion of that in dividends, but that leaves them with almost $1 billion in just free money to buy properties at a cost of zero, or to pay down debt, or to continue raising their dividend, or to weather the storm of higher expenses, higher interest rates, etc. So there's flexibility there, right? Their AFFO payout ratio is in that 75% range, and that's pretty good. That leaves me feeling comfortable that the dividend is pretty safe, despite the specter of potential debt problems on a go-forward basis, even if interest rates stay elevated. If you kind of think about this pattern playing out throughout the entire year, throughout the 10-year period that they show here, their rent escalators are probably going to yield about $800 million in additional rent at a 1.5% escalator, which is probably going to get higher as the year progresses, so that's conservative. And their additional interest at a 300 basis point escalator is going to be $750 million or so. So it's covered in a way. And the one thing to remember is that the entirety of their rent base gets escalated every year, whereas they only have to refinance a portion of their debt every year. So that's why this isn't a huge, devastating problem. It's still a problem because their rent base, like I said, is only $4.5 billion, and their debt base is $20 billion. So that's a lot more debt than you have rent. And the escalators are lower than the increase in interest rates that you're going to see, but it's not a huge problem in my mind. So as I look at the stock, as I look at what it's trading at today and what they're kind of expecting to see in terms of operational return, if I look at this sheet that they issued with their earnings, well, historically this had a 4 to 5% dividend yield. You add to that maybe 4 to 5% historical AFFO growth, and you get an operational return, which can kind of make sense in my mind as an overall return that I aim for of 8 to 10%. Now that's not amazing, but given that this is a dividend aristocrat, given that this is a really solid REIT, that seems pretty decent to me. So as I looked at it last week when it was giving me a 6.5% yield, I don't think AFFO growth of 4 to 5% is going to be normal for the debt reasons that I mentioned, but I may be looking for 2 to 4% AFFO growth. So 6% yield plus 2 to 4% AFFO growth kind of gets you to the same spot that you've seen historically from a stock like this. You're talking about 8 to 10% operational return, 8 to 10% growth, and you potentially have the upside of this stock trading at a valuation multiple that's currently at 12.3x, that historically has been closer to 15 to 16x. So as you kind of look at that, it's trading near really super lows, kind of the lows is traded during the 2020 pandemic crisis. And maybe this is also the new norm, because if interest rates do stay elevated, this is kind of where it traded when interest rates were as high as they were today. So if interest rates stay elevated, the 12x isn't that crazy. So I'm not really baking on the multiple expanding. But if you think that interest rates are going to come down in the near term or in the future, the problem with refinancing at higher rates becomes less of an issue. AFFO growth could be better than expected. So if I'm expecting 2 to 4, maybe it actually does become 4 to 5% in the long run. And on top of that, your multiple can expand. And if your multiple expands to, let's say, 15, that's just 25% price appreciation on top of that. Obviously, the reverse could happen. Multiple could shrink even more if interest rates go down. That could become more of a problem. They could have trouble growing as much as they've grown because they're a big company now and they have to acquire a lot of properties to grow at a decent clip. But for me, this seems like a decent enough income play for me to be interested in it when it's in that 6.5% or better dividend yield. Because I think their cost of capital is higher, but private markets are going to reflect that pretty soon, and they're going to start acquiring properties in that 8% plus cap rate, which is what they need going forward. They've already made an acquisition for 2024, so that's kind of handled their growth opportunities for that year. And they're looking out to 2025 and what they can acquire, or latter part of 2024. And I think that growth of 4 to 5% that they projected for 2024 makes me feel better, because honestly, I was expecting the 2.5% as kind of the max, the 2.5% accretion that they're going to get from the acquisition is kind of the max. So the fact that they're seeing more than that, given the headwinds of the debt refinancing, that's really solid. Now, what are the negatives? Negatives are, again, this is a retail company. They have 90%, 80% of their businesses in retail, and retail is kind of murky. You know, some of these are pretty good, but as I look 10 years out, am I expecting there to be as many Walgreens locations as there are today? No. Am I expecting there to be as many CVS pharmacy locations as there are today? No. So some of these things are some things you have to keep in mind. I don't love retail. They talked about some bankruptcy and some of their franchise casual dining restaurants, and this was a very small portion of the business. They talked about Cineworld, which has been in bankruptcy since 2022, I think, and how they recaptured about 75 to 85% of the prior rents after they came out of bankruptcy. They basically, they wrote off 6 or 7 of the properties there. And the problem with retail for me is that they're hard to transition into something else. Like if you have a Walgreens and they break their lease, or the lease expires, then they don't renew, it's hard to rebuild those things into other uses. And maybe retail just has too many locations right now. And that's my main worry from a long-term perspective. That's why I'm not making this a huge position, because retail is not my favorite REIT space. I prefer other ones that I'll probably talk about in future videos. But in general, this is a relatively small position. It's an income position. But I liked what I saw during the earnings call. I kind of can pencil in an 8 to 10% return from here at these prices, at the $45 prices that I acquired at least. If it goes back into the $45 range, I'll probably buy more. As always, guys, doing this for entertainment purposes only. Please do your own due diligence before making any investment decisions. This is not investment advice. Let me know what you think about Realty Income. Are you interested in it at this price point at $50? Did you buy more in that $46 range where I was buying it? Will you buy more if it drops? Are you worried about debt? Are you concerned about them cutting their dividend, etc.? Like the video if you enjoyed this. Subscribe if you're new here. And as always, thanks for watching. Bye.